and give it back to God right away. And then the last speaker really excited me about a portfolio. I would take 20% and put in a portfolio. The rest I'll put in a fixed deposit bank.
Okay. Yeah, thank you. Thank you very much. I'm not doing this for the prize. I just want to help my CEO. Of course, kurudishia mwili asante. I think someone talked about the tithe of the 10%. Then we have something for retirees called the drawdown scheme, income drawdown fund. That's a good place to put it because hawezi kuguza until 10 years, you know. So then that time you get a balance in your head. You know, $1 million is a lot with the exchange rate today. It's at 156. Although with the Coop Bank it's at 160. Yeah, so just to market that fund, yeah. But definitely government paper for me, and then 8th Enwealth, the other half. Thank you.
Awesome. Thank you. I am coming with my gifts. The three of you, handing over to Japheth.
Thank you. Let's clap for Melissa again. Now, Mr. Anthony said one of the opportunities that we have is into short-term investment vehicles like money markets and unit trust. Just to mention to us that 8th Enwealth has already tapped into that and they are ready to solve the financial solutions that we have. But I may not be able to speak about it so comprehensively, and therefore allow me to invite to stage Susan Musheke. She leads that team together with Mr. Simon Wafuba to give her moral support so that as she's talking, he gives her moral. Let's clap for them. Tuwapigie makofi tafadhali. Thank you.
So thank you again. Some time back, a number of our customers kept asking that, can we have an alternative way of saving and investment? Because we're just giving them one diet and they were bored. That was pension. So we listened and we responded by creating an alternative saving and investment vehicle, which is now approved by the Capital Markets Authority. And I want to let us know it's doing very well. So what are the funds? We have the money market fund, which is short term. Just in case you don't want to be so surprised that January comes with school fees, that's where to put your money. The returns, as of yesterday, our rate in money market was 14.5% net. Just in case you want to sign up, we are digital. On your desk, just do a QR code like this. You tap there. You have everything on your phone. You will sign up in 5 minutes or less, and you are done. Just like that. And we'll be able to support you in every way. Okay? So money market. In the event, especially for men, you know when you don't have money, you walk in the house carefully. Isn't it? You hear comments like, Papa yenyu alifika sangapi, you sneak in. Okay? This is where to keep the money safely, money market. Then we also have dollar fund. For those of you whose children are schooling offshore, it's a good place to put money so that you put a standing order to fund school fees, especially in this currency fluctuating market. Dollar fund. And it's safe because we have the corporate trustee is Cooperative Bank. They're the ones who are watching over this fund. And we also have a custodian, and our custodian is SBM Bank. And the work of the custodian is to keep the funds in a nominee account of the balance sheet of that bank, which means they are outside the balance sheet of 8th Enwealth. Remember I mentioned we have a portfolio of 90 billion. If that money was in the pockets of directors, this meeting would be in Seychelles, Mauritius, and would have just hired a chopper for all of us to land there. Things would be so easy. But thankfully, because of regulations for safety of our investors' funds, they are arm's length. Custodial banks ensures that even if that bank collapses, the funds are under nominee account. The creditors of those funds cannot, the creditors of those banks cannot attach their assets under nominee. So dollar funds is good. You've sold your coffee, you sold your tea, or you have some dollars that your grandchildren have sent to you, you can open a dollar account and you can grow it together. Our target return dollar rate is about 5% net. Then fixed income, security, and then we also have the balance fund, and then we also have, I think those are the ones that you want to say. So I just want to let you know that apart from pension, we are happy to onboard you. And let me also mention this. Most of you, when we pay you lump sum, you are used to a monthly lump sum of about 100,000 for 20 years. Now we are paying you a cash lump sum of 10 million. Often I see men sweating on the nose. And you know, when men sweat on the nose, know that they are thinking, where do I start? You get? And just to give you a breather so that you think, where do you start? Money market, you can transfer that 10 million into the money market as you think. Sadly, we have had terrible experiences. You pay someone lump sum 10 million, the first thing is they go to Mombasa, bigia mwili pole. And because they were used at 100,000, they quickly reduced the 10 million to 100, where it's manageable. And sadly, sometimes they go with people who help them efficiently manage that lump sum. And then when they are coming back, they are very humble. They call you, nikuulize, hiyo pesa ulikuwa umeweka interest. Ama uliweka tax. Na kwa nini uliweka tax? And they are very humble. So to avoid all those issues, Susan is the place to go. Over to you.
Thank you, Simon. Good morning, everyone. My name is Susan Musheke. I work with 8th Enwealth Financial Services. Tuliambiwa mambo ni matatu, and I will talk about investments and the opportunities that we have in our unit trust scheme. And in our unit trust, we have 5 funds. Yeah, we have been approved by CMA to offer the 5 funds that we have on the screen. We have a money market fund, we have a balanced fund, we have an equity fund, we have 8th Enwealth Dollar Money Market Fund, and we have a fixed income. I'll take you through each of them to just see which suits you best, and then you are able to onboard. I'll start off with money market. Our money market or any other money market fund is a short-term fund that you are in for a minimum of 1 month, a maximum of whatever time that you'd want to be in the fund. It is very convenient for you, very efficient. The features of this fund is that the risk profile of the fund is low. The investment horizon is short-term, a minimum of 1 month, maximum of whatever time you'd want to be in it. If you have any financial need, within the month, you're able to access your funds. 2 working days, you have your funds to the bank account you provided to us or to your M-Pesa. So very convenient. Suitable for investors with low risk appetite and high liquidity needs, those who want to access their funds every now and then. It is suitable for individuals, students, chamas, SACCOs, and many other. Funds in here, we invest in fixed deposits. We've been told by Anthony that currently they are giving us very good returns, and also T-bills because it's a short term fund. The cost associated to this is only 1,000 shillings, and you're able to begin your investment journey. We have our second fund, which is 8th Enwealth Balanced Fund. And this fund balances between the two extremes, between a short-term and a long-term fund. Also in terms of risk, it is in the middle. In terms of period, it is also in the middle. The features of this fund, the risk profile is low to moderate. The investment horizon is medium term, a minimum of 1 year, a maximum of whatever time that you'd want to be in the fund. Suitable for investors with medium risk appetite and people who want to save their assets over time. Funds here are invested in money market instruments and equities, hence the balance of the investments. The cost is the same as a money market fund. 1,000 shillings, you are able to start your journey. Our third fund is an equity fund. Predominantly here we invest in equities. We've been told that all is not lost. Therefore, it's a good time, a good chance to get into this fund. This is a long-term fund. You are in it for a minimum of 3 years, a maximum of whatever time you'd want to be in the fund. The cost is the same as a money market and balanced fund, 1,000 shillings, and you're able to begin your journey. That is our return on money market. We are doing very well. 14.5 as at yesterday, and that is net return. So you're able to benefit from our high returns. That is the link for you to onboard. However, we have a QR code for you to scan and start your investment journey. Our fourth fund is equity dollar fund. Operates the same way as a money market, but for a dollar denominated fund. This provides a medium for investors who want to invest in dollars and to earn a competitive return in the market. Currently doing 5% net, so also a good fund to consider. And our last fund is a fixed income. This is a good fund for investors who want to get a regular income for what they have invested with us. It's suitable for people who want to get a competitive return in the market as they save and grow their assets over time. So why 8th Enwealth Capital? 1 is economies of scale. 2, diversification. We've been told that don't put all your eggs in one basket, and therefore you are able to diversify from low, medium, and high risk funds. 3 is access to professional investments with our fund manager. Access to asset classes that you'd not be able to access as an individual. You're able to benefit from that. Liquidity, you're able to access your funds if you have any financial need. And of course, our good brand, you are also able to benefit from that. In case you'd want more clarification on this, my colleague, Amos Muzenge, and myself are available on call. You can also send us an email with as low as 1,000 shillings. You're able to start your journey with us today of financial well-being for a better tomorrow. Thank you.
Thank you. Thank you very much, Susan. They say that financial freedom belongs to those who are able to tap into the financial opportunities. They never let them go. So that is an opportunity for you. Kindly tap into it na tutengeneze pesa. Ama namna gani? Thank you, ladies and gentlemen. Just to inform us that we are live on Hope TV. So when you see a camera roving around, remember to smile. Your grandmother may be watching Hope TV and will see you and clap for you. Thank you, my co-moderator. Tumpigie makofi again. Thank you.
So we continue with the 8th Enwealth conversations. I want to invite on stage Peyon Makoha. I don't know if I'm saying that name well, but Peyon Makoha, the Corporate Trustees Services for 8th Enwealth, as well as Gift Mbeja, the Assistant Manager for Pensions, Admin, and Consulting at 8th Enwealth, to take us through the 8th Enwealth conversations and unveiling of the 8th edition of the research findings. Karibu sana.
Thank you. Let's clap for her so that she feels encouraged. Thank you.
Thank you, Japheth. I don't know if I felt discouraged, I would have just gone back to the chair. Anyway, as she said, my name is... Hello? Okay, this one is working. My name is Peyon Makoha, and I work for 8th Enwealth Financial Services Limited under the Corporate Trustee Services Department. So, of course, the purpose of this meeting today was the 8th Enwealth breakfast, to say thank you so that you can eat, and also we tell you about a little bit about the survey that we were doing. So the annual conversations. Yes, so this will be the outline of our presentation today. We'll start with a little bit of the introduction to annual conversation. We'll go over all the conversations that we've had before. Then we'll look at the one that we've done this year. We'll have, can't actually see well. We'll have a background of the study. That's for the 8th edition of the annual conversation. Then we'll go through discussions as well as conclusions and recommendations. So just a little bit of the journey. Jeff, how does this thing work? Okay, so I hope everyone is able to see there. We've had several editions over the few years that we've been in operation. Number one, of course, we're talking about the remuneration of trustees and governance in Kenya. The second one was about retirement confidence. How prepared are our retirees for retirement? Some of them say they're not so sure about retirement, and some of them were actually confident and ready to face retirement. So a bit of varying opinions on that one. The third one was on the well-being of retiree during retirement, a Kenyan perspective. We also had attitudes towards inheritance that had to do with the succession laws and all that. The fifth edition was on the cost of conflict in the retirement benefits industry. And then came COVID, so we studied the effect of COVID-19 on the well-being of retirees. The last one, the one that we had last year, was on the saving culture and investment dynamics in Kenya. I believe some of the findings had to do with the black tax effect, as well as the Kenyan economy, how fast it's becoming more of a consumerist economy. Then we had the aspect of low financial literacy, as well as the negative effect of mobile lending apps on the Kenyan citizen. And I think something that stood out from that research as well was the saving culture of couples versus people who are single. Apparently, people who are married tend to save more. So I don't know if this was an encouragement for people, to get married, because you get to save more when you're married. Anyway, from there, one of the recommendations that were given was creation of a smart consumer. When I talk of a smart consumer, ideally I'm talking about someone who is savvy in terms of the products and services that are being issued or offered to them. Someone who understands the disadvantages, the advantages of those savings products and all that. So where do they get this information? Of course, in this day and age, we have technology. That's where most of us are getting most of the information. I know most of us service providers here, we have tried as much as possible to train our people or people who are consuming our products, but sometimes it feels like you're hitting a nail on a, yes, that's a nail on a stone. It doesn't sink in. So they go for information from social media, from newspapers, all those avenues. So that then brings us to the current edition, which is the role of technology on savings and investments. So what did we set out to find? Number one, of course, was to assess the effects of technology on the behavioral aspect of a consumer or someone who is consuming the financial products. Number two was to evaluate the effectiveness of current technological systems that are utilized by various service providers and, of course, consequently, the consumer. Number three was to assess the effects of emerging technological trends. On give a bit of background, I'm sure all of us are Africans here. We are aware that in the last few decades, technology has had a big impact on how we consume finances and the different savings and investment avenues that are out there. The service providers have tried as much as possible to incorporate the different aspects of technology into their processes. I believe Madam had already stated the processes, the products, as well as how the consumers interact with the interfaces whereby these investment avenues and the savings avenues are provided to them. So I believe in Africa, the biggest country that will be leading in technology, that will be South Africa. But now when it comes to mobile money and all that, that will be Kenya. 15 years ago, there was the advent of M-Pesa. I believe I was a kid, and I remember I don't know if it was a tagline, and ilikuwa nasema tuma pesa kwa njia ya simu. And I remember looking at my mom and asking her, so money will be flying in the air like notes and coins, like my vivid imagination as a kid, I couldn't understand how will that be incorporated in transferring of money from one person to the other. But fast forward 15 years later, that's what every one of us is currently using, right? Am I right? Everyone is using mobile money. You go anywhere and you're like, do you have M-Pesa? If they don't have, you're like, okay, that's a bit weird. So technology has played a key role in trying to change how financial products actually utilized, the way we transact, also using money and all that kind of aspects. So, of course, the big question is then, what is the role of technology, and then how will it continue impacting the savings and investments culture in Kenya? So what are some of the findings, the key highlights? Number one was that respondents, this was 63% of the respondents, rely on the internet and technology for their savings, me included, and I'm sure all of us included. One of the speakers alluded that a while back they used to queue to buy shares. I believe if the millennial generation and Gen Z were there at that time, no one would have bought shares. They don't like queuing or going out there. They like when the market comes to them. You know, we like being delivered those products. So if we were there, I believe the shares market would have died. But due to advent of technology, even right now, someone can buy bonds and shares and bills through the internet. There was also respondents who have benefited from broadened choices of financial products tailored to their needs at 64%. Our MD has mentioned that people got bored of one-sided diet. I feel like they got malnourished from just pension. So they introduced other avenues of saving. Money markets, there is money markets, there is REITs, there is, you know, all those types of investment avenues that someone can actually consume. 87% of the respondents experience positive peer pressure to save and invest. Some of us just think peer pressure is negative. It is not. So at times peer pressure works well. You see someone tells you, or maybe even your neighbor, the one you're sitting next to, and I say, I bought a plot, I don't know where, in Kamulwa. You're like, oh my God, me, I don't have a plot. Let me go find some money so that I can buy, so that next time we meet, I'm also saying I bought a plot somewhere. You see, positive peer pressure. So even through technology, influencers and all that, people have this habit of, you know, stretching and getting their phone. If that person stretches and gets their phone, and then the first thing that is being projected to them is an investment and saving avenue that another person, an influencer, is talking about, then they'll be more willing to actually utilize that particular avenue. So moving on, we have accessibility of various financial products through digital channels. 41% of the respondents said that they find it more convenient to save using mobile apps and USSD codes. I know USSD codes is a low form of technology infrastructure, but it works. People have managed to save and invest through using of those USSD codes that are provided by different service providers. At 51%, respondents, they say that they're very comfortable sourcing for relevant information from online sources. That is television, media adverts, you name it. 59% of them, you can note that they said they're actually very, very, very comfortable. 59% are very comfortable, 33% were somewhat comfortable sourcing for that information. I believe that comes with the skepticism of the information that is available online, where some people are not, you know, you don't trust easily the doubting Thomases. So if information is on the online platforms, you'll be a bit skeptical before they can actually utilize it to help inform their financial decisions. But it's a good thing. At least the information is out there, whether they believe or not. So at 63.3%, they say that technology has actually improved how they save and their investment habits as well. So how then has it influenced? Number one is the ease of availability of information on savings and the investment avenues that are there. Number two, of course, is the new choices of products that they can access, and also the issue of the positive peer pressure to invest and to save. One of the questions that we asked, again, is how digital access has positively affected savings and investments. And out of the respondents that we got, 53% said that it is very convenient. It has positively affected them because it is very convenient for them to save through these digital avenues that are available. For instance, mobile apps, we have the USSD codes and all that. Some of them said it is somewhat convenient. I believe that comes into play when someone is not able to utilize those platforms, or the platforms that are available are not very user-friendly, and that goes for the service providers in the room. You need to make the apps and the codes very user-friendly, especially if you're targeting millennials or Gen Z. The moment there is a bump on the road, they stop. And I believe that's what we're getting as the apps being somewhat convenient from the results that we got. So then we asked some of them, how easy is it for you to, or how convenient is it for you to save using manual transactions? And some of them, at that once 16%, they said it's very convenient. I believe these are the people who still have cash money, or the people who would have queued to buy the shares. They said it's very convenient for them. I doubt if there's a millennial who chose that option as manual transactions being convenient for them. But most of them reported this as being not very convenient for them to save and invest. And lastly, we look at the sectoral ranking for technology integration. And of course, banking emerged number one. Kudos to the banking sector in terms of infrastructure, in terms of as well as processes and customer experience as a whole. So the banking industry has also tried as much as possible to stretch the infrastructures that they have, the technological infrastructures that they have, to make sure that they are gaining from it in terms of efficiencies, and also the consumer is actually gaining from it. The rest of the sectors are as ranked, and we can learn a thing or two from the banking sector. So from here, I'll welcome my colleague Gift to come and take us through the rest of the results.
Thank you, Peyon. Yeah, we want to appreciate Peyon in a better way. So by way of introduction, my name is Gift Oscar. I'm part of the team from 8th Enwealth Financial Services. And I'll take the next 5 or so minutes just to wrap up the report on the 8th Enwealth conversations, and also to progress the conversation that you're already having this morning. You'll all agree with me that we cannot talk about technology without talking about data. I was just reading something down there, and the article was saying that over 85% of data that has ever been generated on the surface of the earth has actually been generated in the last 3 years, over 85%. And so this just shows how the advancement in the technology has great impact in our everyday life. I'm also aware, or I'm also sure, that at least each one of us here, in one way or the other, in everything we do on a daily basis at our workplace, we interact with data massively. And so one of the questions also that was asked is just to find out if the respondents are aware of the Data Protection Act. And it's surprising to actually note that 11% of the respondents indicated that they're not aware of the Data Protection Act. Only 48% recorded that they were aware about the availability of the Data Protection Act. 41% were not so sure whether they are aware or not. Probably we could put them under the category of those who do not know. And so in terms of the suggestions that were brought forth on how then the stakeholders and so the players in the market, what they can do to be able to improve the level of Data Protection Act, and also the consumer and the penetration. And so a majority of them recorded that tightening the rules or the law around the data protection, perhaps it could come into play to ensure that they make people to be aware about the data protection. In terms of the regulatory changes, or in terms of the challenges facing the advancement of technology infrastructure utilized in the financial sector, so majority also recorded that there was reduced confidence in the digital platforms. And this was the result of the fraud and the scams that have been reported in the last couple of days. So in terms of technology familiarity, we are aware that also we are moving into the spaces where we are getting now more familiar with the terms that in the past they have not really been familiar, like blockchain, big data, machine learning, and Internet of Things. So it's just interesting to know how people know these categories of technology. And the majority agreed that actually they're aware of the Internet of Things. But again, in terms of the blockchain, we had very few respondents who recorded that they are aware of anything called blockchain. So in terms of the quick wins for the integration of technology in the space of saving and investments, the respondents also admitted that there has been increased in terms of transparency. There is also the rise in terms of the fintech startups. And actually we look for that these fintech startups are going to increase in numbers because also of the advancement in technology. And then there is also an opportunity to explore in terms of investment opportunities that are available, which previously were unavailable to the public, and also ease of accessing the financial services, where at the comfort of your seat and using your mobile phone, actually you are able to access this information. And also there is a lot of empowerment going through in terms of course, in the public domain. And also it was reported that there was efficiency in terms of how people manage their funds. We have a number of apps right now which helps you to be able to know how to manage your finances. And so that is one of the things that were reported. So we are looking at the policies and also the recommendations. Perhaps now this is at the regulatory space, where based on the results that were obtained from this survey, so what can the stakeholders do to be able to come up with policies that now will ensure that even as we advance in the technology, we're actually leveraging and we're optimizing the opportunities that comes with it. Number one, that there should be effort which should be directed towards increasing awareness. And this also to ensure that there is availability of accurate and credible financial information. Unfortunately, we have a lot of information in public, but most of this information is actually not credible and true. Number two, consolidating all services under one roof. And this will ensure that it makes it easy and simple to be able to track the customers and also to explore other avenues and other opportunities that comes about in the investment and saving space as far as technology is concerned. Number three, it was also noted in terms of the policy framework that the financial service providers should create a versatile and user-friendly products and interfaces. And of course, this also means that there is a need for feedback loops, convenient and efficient feedback loops, so that then they are able to tell which areas do they need to improve. In financial institutions should remain agile and also adaptive in case of their strategies to align with the everyday dynamics, so that as they sit down to come up with the platforms to roll out to the consumers, they are sure that this is actually a specific product or a service that will meet the needs of the consumer. And lastly, there's an opportunity to design campaigns and also initiatives that leverage on the everyday social dynamics to promote responsible financial behaviors. As I end, allow me to leave you with a quote: ignoring technological change in a financial system based upon technology is like a mouse which has decided to starve to death because someone moved their cheese. This is a quote from Chris Skinner. Thank you very much.
Thank you very much, Asante. Let's clap for Payon and Gift for just unveiling those findings to us, and most importantly is to say technology is making it easier to save and invest. Ladies and gentlemen, we are walking into the next stages of the conversation, but before we do so, kindly look at your neighbor and smile. Just smile. Mwambie, technology is the thing. Yeah, technology is the thing. Now, because technology is the thing and it is making it easier, we are on LinkedIn. Kindly follow us there. For those who are on technology, the LinkedIn page for 8th Enwealth Financial Services, it's called 8th Enwealth Financial Services. Those on Twitter, kindly do so. Now it's called X. Reverend, Twitter is called X. So if you're looking for it, kindly look for X. Thank you. The hashtag is 8th Enwealth Conversation 2023.
We're moving on to the panel discussions now. I want to call a couple of us to have this conversation with us right on stage. If you could help me, please, to put up the seats. All right. Mr. Anthony Withiga, you know we need you here. We need you here, sir. Please come. The Group Managing Director for Old Mutual Investment Group. Okay. Lydia Mushiri, the Head of Custodial and Investment Services at the Cooperative Bank. Albanas Muthoka, the Assistant General Manager at 8th Enwealth. Orpa Wanyama, the Manager for Legal and Compliance at 8th Enwealth.
Let's clap for them as they are coming.
Yes, please.
Because they are coming to respond to our questions. If you don't clap, your question will go unanswered. Let's clap for them again. Thank you very much. That is the Managing Director, Old Mutual Investment Group. Thank you, Lydia Mushiri, the Head of Custody at Cooperative Bank. And then we have the Assistant General Manager, 8th Enwealth Financial Services, Mr. Albanas Mudhoka, the Head and Manager Legal and Compliance at 8th Enwealth Financial Services. Let's clap for them as they take the breath and they make it comfortable as we start off. Thank you. So this, we will ask a few questions and then we give you a chance to also interact with them so that then you get to have your questions answered. Did we manage to have John Kerr from the Retirement Benefits Authority? No, thank you. So we will...
Karibu sana.
Oh, thank you. Let's clap for him. Sorry, sir. He came and hid himself. He's the regulator. Karibu to stage. He's the Assistant Director Supervision at the Retirement Benefits Authority. Now, ladies and gentlemen, before we even go into the discussion, just give you 3 seconds to tell us who you are, just in a quick 3 seconds.
Wow. Good morning, everyone. My name is Opa Wanyama. I work with 8th Enwealth Financial Services as Manager Legal and Compliance. Thank you.
Good morning again. My name is Anthony Mwithiga. I'm responsible for Old Mutual Investment Group. Thank you.
Good morning once more. I'm Lydia Mushiri, the Head of Custody and Investor Services Business at Coop Bank, and I've worked at Coop Bank for 15 years, having run many facets of it, from fund management, stock brokerage, now custody, and more to come. Thank you.
All right, thank you so much, and good morning, everyone. My name is Albanas Mudhoka from 8th Enwealth Financial Services. I'm in the operations department, and have been at 8th Enwealth for the last 10 years. Just doing pension matters, and I'm happy to be here, and thank you as well, everyone, for coming.
Good morning, ladies and gentlemen. My name is John Kerr. I work for the Retirement Benefits Authority in the Supervision Directorate, where I am an Assistant Director. Let me just take this opportunity also to convey greetings from our CEO, Mr. Charles Mashira, who would have loved, actually was supposed to be here, but he's away in Uganda for some conference, and therefore I'm here to represent the authority. It's an honor to be here. Thank you.
Thank you very much. Let's appreciate them. And maybe just to start off, Mr. Anthony, you look to be the eldest on the panel. You have pointed us to the fact that the investment market is a little bit volatile. As the team of fund managers, what exactly are you bringing to the market to make retirement benefit schemes optimize value outside of the traditional investment securities that we have?
Thank you. It's nice to be an old guy. Yeah, so that's a very good question, and I know trustees here have been worrying about that. So traditionally, pension funds have invested in shares, in bonds, in short-term investments like treasury bills, bank deposits, but over the last couple of years, things have become tough. So currently, what we are encouraging pension funds, boards of trustees to consider is to talk to your fund manager and get more to understand alternative investments. And alternative investments is anything allowed by the regulator, but outside the traditional investments of stock exchange, government securities, or property or buildings, and any other short-term investments. For example, we encourage pension funds to give a closer look to unlisted investments in sectors which are not listed at the exchange. And you don't have to think hard. Just think about the sectors where all of us as Kenyans, as citizens, as members, we spend money every day. So sectors like education, we pay school fees during hard and good times. Healthcare, we seek medical services during hard and good times. That one is housing. But housing being part of property, you have to be careful. It changes a lot. So choose the sectors within the property space which are making sense. For example, currently, there's a good story in, as I said earlier, in student accommodation, some forms of low-cost housing, and thirdly, warehousing. You know, a warehouse is just 4 walls with a roof. That's it. Now, with increasing e-commerce, a lot of enterprises don't have an office. They have a what? They have a warehouse. So as pension schemes, those are some of the things you need to consider. Infrastructure. We know infrastructure appears to be almost a government agenda, but there are vehicles where, as a pension fund, you can invest in infrastructure, etc., etc. But all those are normally structured in some vehicles called private equity, and because it's a requirement for a pension scheme to have a fund manager, your fund manager should be able to speak in detail about this kind of investment and how you get in. Thank you.
Perhaps you can also comment a bit about the impact of holding bonds to maturity instead of now marketing them on the investment performance of the retirement benefit schemes. Holding them to maturity vis-a-vis marketing them.
Thank you. So, yeah, great question. So if you are seated here and you are a trustee of a pension fund, the loss of the unrealized losses in bonds have worried you, hence the good question. So they are losses, as we said earlier, because when you buy bonds and current interest rates go up, those bonds lose value. Bond investments have an inverse relationship with the direction of interest rates. And when interest rates go down, actually those bonds do what? Gain value. Now that up and down movement is not good for long-term savings. And currently, almost a third of the losses or bad returns from pension funds have been brought about by bonds. For that reason, most service providers, fund managers, custodians, administrators, like 8th Enwealth, and the regulators, like the RBA, the CMA, we've been engaging in a lot of conversation and talks how we can improve this and borrow locally and internationally. So locally, close home in Uganda, the equivalent of RBA is called UBRA. They have taken a particular methodology of valuing bonds to stabilize the valuation, because remember, the unrealized loss doesn't mean, as a pension scheme, you don't still own the bond. You still own the bond, but if you are holding it to maturity, those losses are impacting you, quote unquote, unfairly. If you sell the bond, of course, you crystallize the loss. So there is a conversation going on that needs to be cured. That conversation has gone very well. The stakeholders, who are trustees, pension schemes, regulators, service providers, have given their opinion, and there is a convergence of thinking that pension schemes should be allowed to hold bonds to maturity, either all of them or a section of them, and for that reason, they should be spared from the day-to-day, mark-to-market volatilities of prices and values of those bonds. We expect to get some guidance from the regulator, and by extension from the government through the Ministry of Finance before Christmas.
Yes, so from the regulatory perspective, what Anthony has said is accurate, that we are having that conversation. Now, because our purview is the law, we are seeking to amend the law in that regard. We do have some policy proposals that we have tabled to the National Treasury for its consideration. As you are aware, the requirement to mark to market is contained in the regulations, and therefore the regulations shall have to be amended for them for schemes to hold to market. So yes, we are looking forward to the government passing this legislation that will then positively impact schemes valuations. Also, just to speak on the issue of alternative investments, the regulations do provide for investment in 15 asset classes. They are the traditional ones that he listed, but also the alternative ones, and therefore, as trustees, we encourage you to engage with your service providers, particularly the managers, to explore the opportunities that exist in these classes. He did mention about the unlisted shares and equities. There's offshore opportunities, exchange-traded derivatives, real estate investment trusts, private equity, and also debt instruments for financing of infrastructure and affordable housing projects. So as a regulator, we are trying to give schemes the opportunity to maximize on investment returns in this regard.
Thank you very much. So briefly, Lydia, as we are talking about investment, and going back to the conversation around technology, as a bank or as banks, what are you doing to improve the saving culture of Kenyans using technology in just 1 minute maybe?
Thank you. I'll tell you 2 things that we are doing. Number one, you cannot invest or save if you don't know about investing or saving. So it is investor education. And in the era of technology, we are running webinars where so far year to date we've run about 107 webinars to our customers to educate them on all these matters of investments and savings. We also run forums like this one. This is, you can clearly see me here. So we've had year to date about 35 of these forums where we are educating our customers and our partners on investments and so on. We also run clinics at the grassroots. Remember when I was presenting and saying that Coop Bank operates from the grassroots. So we do the webinars for the technologically savvy, and we also do clinics at the grassroots, and again we've done very many this year. Then the second thing to enable investments through technology is to make sure that that user journey and experience is good right from onboarding. Because for you to invest, first of all, you need a bank account. So at the stage at which you're opening the account, that process needs to be very easy, and you'll simply visit our branches and not fill forms. Once you're there for us to KYC you. Remember, when we are dealing with finances, we need to be sure you are who you say you are. But after that, 91% of all the financial transactions are being done through digital channels. So we've invested very heavily. We've got the mobile apps for Coop Bank and Coop Cash. We've got the omni channels, and we've also got other investment avenues. If you want to buy shares, you won't queue because you've got the KSL trader. So we've got very many products and services that help our customers to save for their retirement and also to save for their other goals and needs.
Thank you. Thank you, Lydia. Mr. Anthony, so that then we just dive into the investment world and move on from that. About 1.6 trillion shillings being held in the pension book. The government is asking, are we using this money to drive infrastructure development, and can that be leveraged to help, generate value and optimize value for trustees from where you sit as a fund manager?
Thank you for that question. So the size of the pension industry in Kenya is really big. It's the biggest in Eastern Central Africa. So at 1.6 trillion shillings, definitely these monies need to make an impact in the infrastructure space. It's been unfortunate that close to 2/3 of the money has been invested in the traditional assets, which we say they are either bonds or shares. But now with the realities of volatilities in those traditional assets, they need to develop the economy, because we are saving for retirement. So we need to retire where there's good infrastructure, where there's good electricity, there's good roads, there's good amenities. I'll tell you where I come from, my village, I'm yet to get electricity. So So why work so hard, save, and go and retire in darkness? So for that reason, pension funds have been encouraged, and as we are being told here by the regulator, actually those opportunities have always been there. But I must admit there's been 3 challenges. 1, awareness of trustees. Number 2, and I'll be the first person to admit, skill set from the service providers. And thirdly, vehicles to invest in those opportunities. Because if you are a pension fund, how do you invest in infrastructure? That is difficult. Some 2 years ago, we challenged the Minister of Transport that how come they never gave the pension industry the opportunity to build the Nairobi Expressway. It's only 88 billion shillings. Pension funds every month invest over 50 billion shillings in government bonds. They could have written the check if they are given the opportunity and the return for that road was shown to us. So the challenge is clear. Currently, as a pension fund, you can invest in infrastructure in 3 ways. 1, there are infrastructure funds, and please put pressure on your fund manager. They are there. Where I work, a lot of pension funds, we've enabled them to invest in infrastructure funds this year, earning dollar returns, and infrastructure within the country and within the continent. We have to develop our country, but we have to be open-minded enough to get opportunities outside the country.
Thank you.
Thank you.
Thank you very much. Mr. John, you're my neighbor right here. The projection by the World Bank is putting us at around 90 million Kenyans by 2050. I know that's quite a huge population. As the authority at the helm of retirement benefit sector, are there policy formulations that you're putting in place, to manage the dynamics that come with that population?
Yes, we do, and this basically is hinged on our regulatory framework, the Retirement Benefits Act, the regulations, and all other subsidiary legislation to promote, to ensure that all these people have access to pension products. So in that regards, let me briefly talk about our mandate. Our mandate is really to develop the sector. And the development of the sector looks at not only the people who have access, who are saving through schemes, but also the various service providers who are going to offer services, but also the types of products that are going to attract people into the sector. On these opportunities that these 90 million people are going to present. Now, currently, we have, out of the, assuming we are about 55 million right now in Kenya, 29 of those are working force, 29 million, which translates to about roughly 52% thereabout. That means that if we use that as that ratio going to 90, a significant amount of those will be people who are working. Now, are they saving for retirement? Are they in pension schemes or pension arrangements? Currently, we know that out of this working force, 82% are informal, whilst the other 18 are informal. So the question is, do we have adequate programs in place to attract what could be the significant informal arrangement? For formal, we are good. We have occupational schemes. We have the service providers who cater for occupational schemes. But for the informal, now that's a $1 million question. Do we have adequate products for them? What then would be adequate products? These people will be characterized by that. They'll be the are we Gen Z now? Yeah, Gen Z. And so they're probably tech savvy. They probably are interested in accessing services through technological platforms, etc. So are our offerings relevant to their needs? So what, as RBA, we're doing is reviewing our regulatory framework to facilitate development of technologically offered products And therefore, I would say from primarily the regulatory perspective, we are reviewing our framework to ensure that it will provide for some of these adaptations and emerging needs. Thank you.
Can I ask Albanas, tell us about some income adequacy, where we are at when it comes to income adequacy as a country?
All right, thank you so much. And in this, I'll talk about the income replacement ratio as a country. From a survey which was done some time back by the Retirement Benefits Authority, is the income replacement ratio, which is a ratio of your pension to the income or your pay before retirement, is around 34%, which is an increment from 22% back in 1994. This is still quite low if you compare to other developed countries, where it is between 60 to around 80%. And therefore, as a country and also as a stakeholders, we have a very big role that we need to be able to play. Because when you're talking about 34%, what it means is that if you're earning a salary of 100,000 before retirement, you are retiring with 30,000 Kenya shillings. That may not be sufficient to be able to guarantee a comfortable life in retirement. But the biggest issue around a very low income replacement ratio is because of the behavior we see, and especially for members who are leaving employment before attaining the retirement age. 95% of those members actually cash out their money. It's like you're borrowing from your future. And when you retire, then what you have is not sufficient to sustain you, and therefore you start paying for past borrowing, where the money you have is not sufficient to sustain you, and you have to start depending on your family and your children to sustain you throughout your retirement, which is a sad state, because, and I know maybe in very few years to come, a majority of us will be put in retirement homes, because even our children are not willing to stay with us. And therefore, I think as a country, as a conversation, we need to look at our saving culture. And I can even ask, even for majority of us who are here, how many of us have been able to do a projection in terms of how much do I need in my retirement and how adequate is it to be able to sustain me? Very few of us actually are able to start making those projections early enough. And that conversation comes towards the tail end of retirement, and that's when you start seeing people putting in some additional contributions so that then they can be able to have a significant or reasonable amount in retirement. And therefore, we need as trustees, as stakeholders, to be able to have a more conversation with our members so that they start preparing for their retirement. They are able to project how much do I need to be able to take care of my retirement. The recommended rate is between 70 to around 80% for you to retire comfortably. And again, as trustees, we begin those conversations with members. We have those projections, even when you're having your member education and your AGM, sit down with the members and tell them, if you retire, this is how much you're going home with. And therefore, this, if it is not sufficient, what do I need to do as a member? I need to put in more money in form of voluntary contribution. As well as Board of Trustees is a conversation, even when you are reviewing the investment policy statement, to be able to see is, can we make a projection in terms of income replacement ratio, which is sent out to individual members in terms of how much then you need. Once you do that, it informs you of the adequacy of the funding rate by the scheme. If there's a room to review as a board, then you can approach the sponsor. I know there are quite a number of factors that may need to be considered, but again, to be able to look at your funding factors, are they adequate? Is there a room for us to be able to make some adjustments to take care of our members in their retirement? Look at then the issue around the investment income, and that is now where you are putting a bit of pressure on the fund manager, because again, you have a target, and say, this is the return we need to be able to achieve this income replacement ratio. And how do we work together as trustees and the fund manager to be able to achieve that particular return?
Thank you so much. Lydia, I think I'll come back to you and ask you, because you're keeping our money safe as a custodial bank. So how safe is our money?
Yes, I confirm the money is very safe, and one of the biggest threats that currently exists in financial services, not just banking, is cybersecurity. And so a number of things that need to be done to make sure that that money is safe is to protect yourself against those cyber security threats. Work with the experts in that area, the cyber security experts. Then number 2 is keep your systems very up to date with the latest technologies. So you had me mention earlier on how Coop Bank in June overhauled, not just updated, but overhauled its core banking system to make sure that it is up to date with the most recent technologies. Then the third thing that one needs to do to keep the money safe or the system secure is to make sure that internal threats, because threats don't come from nowhere. Somebody knows and cooperates with an internal actor. So you train your people and make sure that they know all the things that they need to do to make sure they're not clicking funny links. First of all, those links are not even coming in, but in the event that they do, they know that they should not click them and introduce viruses into the system. Something else I would say is monitor suspicious activity. You'll realize that there's an observation that's been done that shows a lot of those things tend to happen at night because people expect your guard to be down. So again, you increase your guard at those times. There's the monitoring of suspicious activity through the relevant systems. It's not just human beings, but as I said, we work 24 hours. So even when the bank has scaled down its operations during the night, there are still systems checking on that security, flagging off any suspicious activity, and so on. And to show that something is being done right, you know, Anthony was saying I'm a crusader for Coop Bank, but the evidence speaks for itself. Last week, our Chief Information Officer, our Director ICT, was awarded the Best CIO of the Year award. And this is a peer award where fellow ICT people sit around and look at all the things that have been done and nominate each other and vote and so on. So it goes to show you that in this area of keeping your money safe through technology, we are doing something right. Thank you.
Thank you, Lydia, for that. You are an evangelist, let me say so. John, Albana's talked about income adequacy, and just in 1 minute, the Gen Zs, they want their money right now and to eat it right now. So how do we then balance between saving to secure our income adequacy at retirement and eating our money? Kupigia mwili pole sahi.
Wow, okay. So the Gen Zs, first and foremost, I think education is important. And that has been reiterated by several panelists here. Why? Because then they need to know that there is today and there is tomorrow, and that there are benefits towards saving for the long term. Because I'm from the pension sector, my bias is towards the pension saving models. And I would say, firstly, I would tell them of the advantages of saving through retirement benefit schemes. Is that, especially if you're in an occupational or umbrella arrangement, you don't only contribute your money, but also your sponsor contributes for you. So you kind of are saving on a dual way. That in itself is an advantage. Whilst if you consume today, you're consuming for yourself, and then tomorrow you have nothing to show for it. So there is that advantage towards that. There is growth through the pension schemes, through the investments, as we've had, different asset classes. There are licensed fund managers that we have. We also have different approaches to cater for the different feelings of investment. We have guaranteed funds, we have segregated. So depending on one's risk appetite, you can save through such models or approaches. The other thing is we have tax incentives in the pension arrangement. We have that lump sum that was talked about. There is an exemption when it comes to its payment of about 600,000 shillings. When you are receiving your pension, there is the first 25, between the ages of 60 to 65, the first 25,000 is not taxed. And when you are receiving your investments, when you're contributing first and foremost, the first 20,000 is deducted from what is tax is charged from that. So there are quite a number of incentives, that tax incentives that would then be of benefit to a young person. And then of course, if that's invested, the power of compound interest, the growth towards that. Then at the end of it all, when you are now retiring, there is the management of those benefits. Yes, you can be given a lump sum, but we did hear the example of Wanawafubwa of going to Mombasa and using 10 million shillings. And I think there was a real one where some used 700,000. And after that was in dilemma. Now, we have what are called the annuities, which then assure you that you are going to have income for the rest of your life. And then we have the income drawdown that was spoken about, which is also has an investment option or feature in it. And so it is basically to educate them on the advantages, the long-term advantages over the short-term aspect. So that's what I would tell them in a very convincing, contemporary way. Thank you.
Thank you. A yes or no answer. He talks about leakages along employers. Is it possible to lock the whole amount while you're still in employment, before retirement? Yes or no?
Well, no, currently. No, yes. In the future, that's a conversation I struggle with. Ideally, it should be that we should lock in. But I'll tell you the genesis. Several years back, with retrenchments and all that, people were exposed to, poverty, and yet they had money in some of these schemes. That's why the introduction to access a portion was introduced. Now, prior to what we have currently, which is 50% of the total benefits, one could access 100% of their contributions and interest and 50% of the sponsors. We've managed to reduce that by just going to 50. So maybe in the future, a reduction, and with financial literacy and the need to save for retirement and keep that, secure your future, hopefully we'll get to the no at that point.
Thank you.
Can we talk about the NSSF Act a bit and how 8th Enwealth is responding to it? Orpha is already looking at me. She knows that's on her desk. Yeah, could you kindly tell us what 8th Enwealth is doing to respond to some of the issues that have been raised by the NSSF Act?
Thank you very much. Most of you will remember that once the NSSF Act was reinstated, we called you here. We educated you. We told you about the NSSF Act, what it says to you as employers, what it means to you as members of pension schemes, what it means to you as trustees, and what it means to the industry. So as 8th Enwealth, we have educated employers. We have assisted employers get approvals from RBA on the opting out of making Tier 2 contributions to NSSF. We have engaged our clients, made applications for them, for their schemes to be contracted out schemes. And thanks to RBA, the process has been very seamless. Most of you here will attest to the fact that most of your schemes have been contracted out of making these contributions. As 8th Enwealth, we have made a lot of infrastructural investments just to ensure that the system is able to accommodate Tier 2 contributions. So as you log into our system, you'll be able to see the segregation of the Tier 2 contributions as well as the Tier 3 contributions, the current pension contributions, what most of us are calling Tier 3 contributions. Looking at your statements again, you'll see the segregation. We've gotten the approvals from RBA. We've assisted our clients to make applications for reimbursements from NSSF. Whether the reimbursements have been made or not, that's another story. And I'm happy that the regulator is here. He can assist us with follow-ups on those reimbursements. Thank you.
Thank you. Thank you, Opa. Maybe in the interest of time, so that we open it up to the rest of us to ask the questions. I'll just give you 1 minute, a parting shot. Not 1 minute, 30 seconds from this side. Parting shot.
Anyone with a question in the audience, kindly just lift up your hand. We will come around once they're done with the parting shot.
Okay. I'm told we do the questions, just 2 questions, and then we give them an opportunity to do a parting shot.
My name is Roger Zodima from the CEO Association. I just have 3 points. Number 1 is a lot of what we have been discussing here is private sector led. I'm saying this because RBA did a study one time about savings culture in Kenya, and they realized savings actually just comes number 5. After you meet your basic needs, then you do savings. What are we doing, even in the private sector, to ensure that we reduce poverty in Kenya? Over 80% of Kenyans can't afford food, can't afford school fees, can't afford medical costs. So even as we talk about all these vehicles and products, what is it, as the private sector, are we doing to reduce poverty? Then the second one is just a question, especially in the banking sector, and even the whole of, as we think about technology. I'm finding that as we invest in technology, customer service is becoming very impersonal. Very, very impersonal. I'm just dealing with it. But maybe because I'm of a different generation, the generation of Dawn and other. So I'm finding that customer service, you are just dealing, for example, like what you said, the webinar, I'm part of COP, just send an SMS, whether I respond or not. Every Thursday, even today, they have sent me. Whether I respond or not, nobody cares whether I'm part of that webinar or not. So I'm finding that even the more we talk about technology, the more impersonal and poor customer service we have.
Thank you. I think that Lydia, you will respond, and then Anthony, you will respond as a private sector, what we're doing to curb poverty in just 1 minute each. Yes?
Well, morning everyone. I'm Mary Kongoto, a trustee. I just have one question, and I'll try to bring it this way. I stand with the Reverend for your prayers and the word of God to thank God where we have come from up to date. 8th Enwealth, for me, I'll say last year we were at Radisson. Today we are here. Next year, God willing, I'll be Canaan, where maybe we can fly to Sarova, Mombasa for this event. Now, I'll be straightforward to this. We saw the graphs from our economist, up and down, the interest rates, the taxes.
Thank you. You make it brief.
And to be brief.
Yes.
All of us here, what can we do so that, God willing, next year, we may not say that because of this is why we missed this. After all this, because actually for the education, we thank you. And it's good even the regulator is present. So my question is, in as much as we have this issue of taxes going up and down because of that will be there, what can we do?
Thank you.
In addition to that, we know where our Kenyan shilling is.
Thank you. So in 1 minute, Anthony, on the issue of outlook and then poverty as a private sector, what are we doing? And then Lydia, you will talk about the customer service in personal one.
Thank you. So to alleviate poverty, good question. What the private sector is doing is actually now having been entrusted with all these savings, which are motivated by government policies, is actually now to encourage owners of those monies, who are the pension fund trustees here, to invest in the sectors which have the biggest impact. And that's why I talked about the sectors here, the 5 key ones: education, healthcare, infrastructure, etc. Because that's the only way. Where capital goes, it's where comfort